So thanks for joining us, Rick. Look, I've just tuned into your last monthly update on the Adansonia Global Opportunities portfolio, which is run in the Shartru MDA, and mate, a great set of numbers. So outperformed the index by 9.6% over the last 12 months for a return of 28% plus.
Yep. Thank
you. Which is a great return. But also when we look at the 3-year numbers, we've got 14% per annum as against the benchmark of 10.7, which is outperformance of 3.3% per annum, which is really good numbers. So, mate, the strategy, the way you're seeing the world, seems to be working at the moment.
Yeah, Rob. No, thank you very much, and thanks for having me on today. It's working well, and I think it just sort of reaffirms that the approach that we have works for this product. So the approach ties in very well with our philosophy, and also that the team is experienced enough to basically properly sort of employ or implement the approach. So we've been using this approach, which is a top-down, bottom-up approach, for decades, through various different products, and both Tony and myself, basically been blooded in the same investment process, and it works well. It works well. So effectively, it's a holistic approach. So it gives us a better insight into company valuations, but also the investment outlook. And it helps us avoid value traps, and really just basically helps us build the right portfolio for the investment outlook. And we focus a lot on the macro. So far so good. Knock on wood, we've delivered good results for the MDA.
So, in the investment world, we like to put labels and tags on things. We like to call people value, growth, what have you. What would be how would you describe your fund and your philosophy on and how you go about managing the money?
Yeah. Okay. Look, look, Buffett basically says there's very little difference between value and growth. But if we have to put a label on it, we're obviously a growth manager. Growth is a very important determinant in the valuation of a company, and we essentially look for companies that can grow their top line revenue at a rate greater than nominal GDP, and then have good operating leverage to basically grow profits higher than that. And we have a 5-year investment horizon. So we look for companies that have very long runways of organic growth, and especially sort of in a low growth environment, which we believe we're heading into. We have the right portfolio for that outlook. So look, we're a growth manager, but obviously in saying that, we focus very much on fundamental value, and we look for companies that we believe are mispriced by the market and offer value as well. So look, we look for companies that can grow, but obviously that are cheap as well. So as I said, it's a combination of both.
Yeah. Well, I think it was Buffett that said that there's no point buying value if there is no growth. So you actually need both, right?
Yeah. Exactly.
So on the value side of things, when you talk about valuations, and we all know that valuations can get very lofty at times.
Yes.
What's the screen, or how do you guys approach the valuation piece of the puzzle?
Yeah. So look, it's so look, as I said, I guess that we get questioned quite a bit how a team of 3 can basically run a global mandate. So we put in systems which essentially screen, the universe of stocks, which for us is about 1,500 stocks on the MSCI World Index, and we look for particular characteristics, around growth, around balance sheet, around free cash flow generation, etc., like that. I won't go into a lot of detail because we believe it's proprietary, as does every other manager. But look, from there, once we essentially knock down a universe from around 1,500 stocks to about 150 stocks or 130 stocks, that's essentially what gets thrown out at the end of the screen. We just do a deep dive. So we build models. We focus very much on free cash flow generation. And on the back of that, obviously, DCFs, PEs, PULs, etc., like that. So we look at many measures, but first and foremost, it's really just about the ability of the company to generate free cash flow, and I guess the risk around those free cash flow streams, which we value, and then essentially we value those. So again, it is a very fundamental process. In saying that, I agree with you at the moment. The market is in a very happy place. As I said, thank you for sort of saying that we generated a 28.7 for the rolling 12 months to end of 30 June. But, the market itself generated 19%. as we define it, which is the MSCI World Index or in all accumulation index in Aussie dollars. Now, look, part of that's going to obviously be currency depreciation, but still, a great result for a market, which has faced huge headwinds through, a very strong tightening, aggressive tightening cycle globally, and also inflation. So the market's basically pricing in a soft landing, especially in the States. We're getting very much to the end of the tightening cycle. There's maybe another one left in the US, or we just had one now in July, so that's pretty much it. Inflation is coming off fast, and essentially central banks have managed to basically battle inflation without destroying economies, and essentially investors are in a relatively comfortable place about that. It's interesting, sort of through the last reporting season, that the outlook for earnings has held up really quite well. So it's not the doomsday scenario that people were looking at earlier. And look, I think in our last monthly or monthly before last, we sort of had a base case where we didn't believe the US and Eurozone was going to go into recession. The Eurozone actually has had a small recession through winter of the last 2 quarters, but we think it's going to be shallow. But look, so it's a question of there's good news priced in the market. So the market isn't showing a lot of value overall, and basically what's driven the market to these levels. And I think we're about 5% of record highs actually with the S&P 500. It's really quite outstanding, but it hasn't been broad based. So obviously there's been a lot of fervor around AI, and a few very large stocks have driven the index where it is at the moment. It hasn't been broad based. So we're cautious. But again, we look for companies which we believe do have value. So it's very much a stock pickers market. It's a market for active managers, not a market for passive managers. There are a lot of big stocks that are showing no value. So we just got to tread cautiously, and portfolio's positioned for that at the moment.
Yeah, look, I think from my very simple take on things is as you said, we're not far off the all-time highs, but we've got a level of interest rates which is considerably higher than what it was a few years ago.
Yeah.
And interest rates is the determinant of net present value, which is the determinant of valuations, right?
Yep.
So
Yep.
we've got there's fundamentally something not necessarily sitting right there.
Exactly.
But as you said, it hasn't been a broad-based rally. It has been I think there's about 7 stocks that now make up a huge part of those gains that have come through, and I agree with you entirely. I think I probably disagree with the view on inflation, but I do think it's going to be a stock pickers sort of world, and the days of passive investing are probably not going to do well for the next little bit.
Let me just qualify that. Inflation in the US is coming off relatively quickly. Obviously elsewhere, Eurozone core inflation is up. Here it's stubborn, but generally, obviously, the US being the major market, inflation is actually coming off quicker than what we thought it would.
So inside the portfolio, Rick, what are the sorts of ideas and things that you think are going to be sort of the good performers over the next few years?
Yeah, look, so obviously, Rob, I mean, we've I think easiest way to answer this is to point you to our monthly, which we put on our website. Quarterly, which we put on our website. So we published the quarterly for June a little while ago. And in the bottom of that, at the very back end of the quarterly, we have little pie charts. And one of the pie charts looks at the key industries that we're invested in. And I think from memory, there are about 11 industries that we're invested in. So look, what we're largely, the stocks that we hold have very strong structural themes. So so they've got, generally the portfolio has relatively low economic sensitivity. We have no resources apart from Shell, which is a small part of the portfolio. But effectively, these are stocks that don't need a strong economy to basically drive strong profit growth. So these are companies that are driven by long-term investment themes, and our investment horizon too is 5+ years. So when we basically when we interrogate a stock, when we value a stock, we have a longer-term investment horizon than many other managers, which helps us better catch these long-term themes. So look, a lot of themes that people are attuned with. So obviously decarbonisation, AI, electric vehicles. obviously health as the people are growing, older. We've got obviously growth in non-cash payments, which is very much linked to urbanization, industrialization. We've got some specific country themes where we think obviously a country as in general is going to essentially be maturing or sort of moving away from emerging to more developed. And the nice way is that the way we catch these developing these emerging market themes is that we do it through global plays. So essentially, if we have a play that is invested, or has exposure, like for instance in Mexico, if something blows up there, it's only a very small portion of their business. So again, we have we play large caps on established first world bourses. So obviously, we don't invest in cowboy country like Kazakhstan directly or anything like that. But these companies do obviously have exposure, globally, which is what we're looking for, and they can, give you an exposure to these emerging market themes. So look, I mean, easiest thing, to tell you the truth, I can't remember them all off the top of my head. But look at the quarterly on the website www.adansonia.com.au. It's under reports. And there are 11 industries which basically reflect those themes, and they're largely the ones that we play. But look, main thing is low economic sensitivity, long-term plays with long-term structural drivers. And again, they help weather the volatility that you see in the market around that essentially cyclical plays essentially pick up and can deliver, and that we're trying to avoid that.
Well, just picking up on your position in Shell there. So I actually think energy is an interesting one. I think I heard elsewhere over the last little bit that Shell's it's on single digit earnings. Yeah.
Oh yeah. Shell's ridiculously cheap. On top of it too, look, Shell is playing the decarbonisation theme. So there's a couple of different levels there. First and foremost, gas is a transformation energy where essentially the world's moving to renewables. It's trying to move away from coal, etc., like that. But the fact is, when the sun doesn't shine and the wind doesn't blow and it doesn't rain, renewables don't work very well. So gas is as clean as you get in terms of a fossil fuel that basically fills in the blanks around renewables. Shell's also moving to basically be biofuels business. And also, the company is ridiculously cheap because it was based in UK, Europe, obviously, when they were having that energy crisis there. Single-digit earnings, I think a yield of around 4 or 5%, if I can't remember. It's currently basically buying back shares and has boosted its dividend as well, because it sees that it's essentially underpriced to its peers. So it's we think it's a good play, and obviously LNG. Is a fuel source, obviously, to deliver, like a clean transitional sort of fuel around the world, and they're the largest LNG exporter in the on the planet. So look, we like the outlook there. Obviously, again, one of the things with the portfolio, it is very diversified. We do have exposure to a lot of industries. So that's the only resource play that we have, and we think it's well positioned.
Yep, excellent. No, well, thank you, Ric. And I know that a lot of people watch the monthly updates, and every month you give us a little bit of an insight into a holding, which is great for the advisors, and also it's a great war story for them to be able to pass on to their clients. So, mate, keep up the good work.
Thanks very much.
And thanks for joining us today.
No, my pleasure. And look, as always, if anyone wants to have a chat, we're very approachable. Just all the monthlies or the monthlies which we do have our contact details on the front. So give Tony or I a buzz. But otherwise, Rob, thank you so much. And we're very happy to be part of the Shartru network. And we appreciate the support. Thank you.
Thanks, Ric. Good on you, mate.
Thanks, Rob. Have a good day.
You too.